Picture this. It's Monday morning, your alarm goes off, and instead of dragging yourself to a job you hate, you roll over and check your phone. 3 deposits hit your account overnight. $800 from Realty Income, $650 from QYLD, and $420 from JEPI. That's $1,870 in passive income while you were sleeping. You smile, turn off the alarm, and go back to bed. Because you've cracked the code. You've built a dividend machine that pays you $2,900 every single month to do absolutely nothing. No boss, no commute, no trading your time for money, just cold, hard cash flowing into your account like clockwork. Sound impossible? It's not. In fact, I'm going to show you 3 different strategies to make this happen, including one that could get you there with as little as $300,000. But here's the thing, most people approach dividend investing completely wrong. They chase the highest yields without understanding the risks, or they play it so safe they'd need millions to generate meaningful income. Today, I'm breaking down the fastest ways to build a dividend portfolio that can replace your salary. We're talking real numbers, real strategies, and real timelines. Hey, I'm Brandon, and welcome back to My Money Mint, the channel where I dive into topics related to money and wealth. All right, let's get into it. Before we dive into strategies, you need to understand the fundamental math that will determine your financial freedom timeline. Living off dividends means building an investment portfolio that generates enough passive income to cover your living expenses. Let's use a target of $2,900 per month. That's about $35,000 per year. Now, here's where most people get it wrong. They think dividend investing is just about finding high-yield stocks and buying them, but the relationship between yield and required capital is everything. Check this out. If you invest in conservative dividend aristocrats averaging 2% yield, you need $1.75 million to generate $35,000 annually. That's a massive amount of capital. Bump that yield up to 3%, and you need about $1.17 million. Still substantial, but much more achievable. Get to 5% yield with blue chip REITs, and you're down to $700,000. But here's where it gets interesting. If you can find quality investments yielding 8 to 12%, you only need $300,000 to $450,000. The difference between a 2% yield and a 10% yield isn't the difference between needing nearly $2 million and needing less than $500,000. But, and this is crucial, higher yields often mean higher risk and less growth potential. Lower yields typically mean safer investments, but require much more capital. The key is finding the sweet spot between yield, safety, and capital requirements. Let's start with what I call the turbocharged dividend machine, covered call ETFs. These funds use a strategy that most individual investors can't or won't implement themselves. They buy a portfolio of stocks, then sell call options on those stocks to generate extra income. Here's how it works. The fund owns shares of companies like Apple, Microsoft, and Amazon. Then they sell call options to other investors, essentially betting that these stocks won't rise above a certain price. They collect premiums for selling these options, which they pay out as dividends. The most popular covered call ETFs include funds like QYLD, XYLD, JEPI, and RYLD. These funds typically yield between 7% and 12% annually. Let's look at one popular fund as an example. This fund has been paying around 11 to 12% annually, distributed monthly. If you invested $350,000 in this type of fund, you'd be generating approximately $3,500 per month in dividend income. But here's what makes this strategy attractive for living off dividends. Most of these ETFs pay monthly, not quarterly. Instead of waiting 3 months between payments, you get cash flow every single month. JEPI is another favorite because it combines covered call strategies with dividend growth stocks. It typically yields around 7 to 9% while still providing some upside potential. The pros of this strategy are obvious. High income relative to capital invested, often monthly payouts, and you can start living off the income relatively quickly with a smaller capital base. But there are significant cons. These funds sacrifice long-term growth for current income. When you sell call options, you're essentially capping your upside potential. If the underlying stocks have a massive run-up, you don't participate in those gains. Also, the tax treatment isn't ideal. These dividends are typically taxed as ordinary income, not at the lower qualified dividend rates. The bottom line with covered call ETFs is you need approximately $300,000 to $400,000 to generate $35,000 annually, but you sacrifice growth and face higher tax rates. Real estate investment trusts, or REITs, offer another path to high dividend income without needing massive capital. REITs are companies that own, operate, or finance real estate. By law, they must distribute at least 90% of their taxable income to shareholders as dividends. This creates a unique situation where you're essentially getting paid to own real estate without dealing with tenants, maintenance, or property management. There are two main types of REITs to consider. Equity REITs own and operate actual properties like office buildings, shopping centers, and apartments. These tend to be safer and typically yield 3 to 6%. Mortgage REITs, or MREITs, don't own properties, but instead hold mortgages and mortgage-backed securities. These are much riskier but can yield 10 to 20%. Let's start with the safer equity REITs. Realty Income, ticker symbol O, is the gold standard. They call themselves the monthly dividend company because they've paid monthly dividends for over 50 years. They currently yield around 5% and have a track record of consistent dividend growth. If you invested $700,000 in Realty Income at a 5% yield, you'd generate $35,000 annually, paid out monthly. That's about $2,917 per month in passive income. For broader exposure, VNQ is Vanguard's REIT ETF, giving you exposure to hundreds of REITs with a single purchase. It typically yields around 4%. Now, if you want higher yields and are willing to accept more risk, mortgage REITs like AGNC and NLY can yield 10 to 15%. These companies borrow money at short-term rates and lend it out at long-term rates, profiting from the spread. The problem with MREITs is they're extremely sensitive to interest rate changes and economic conditions. When rates rise rapidly or the economy struggles, these companies can cut their dividends dramatically. If you could find stable MREITs yielding 10%, you'd only need $350,000 to generate $35,000 annually. But the keyword is stable, and that's not guaranteed with high-yield MREITs. The advantages of REITs include diversification into real estate, regular payouts with some paying monthly, and the potential for inflation protection as property values and rents rise. The disadvantages are sensitivity to interest rates and economic cycles, and mortgage REITs can be extremely volatile with dividend cuts during challenging periods. For REITs, you're looking at $350,000 to $700,000, depending on your risk tolerance and yield targets. Dividend aristocrats are S&P 500 companies that have increased their dividends for at least 25 consecutive years. These are the slow and steady golden geese of dividend investing. We're talking about companies like Johnson & Johnson, Coca-Cola, Procter & Gamble, and McDonald's. These businesses have survived recessions, market crashes, and economic upheavals while continuing to pay and grow their dividends. The average yield for dividend aristocrats is typically 2 to 3%, which means you need substantial capital to live off the income. To generate $35,000 annually at a 3% yield, you'd need approximately $1.17 million invested. But here's why some investors prefer this approach despite the higher capital requirements. Dividend aristocrats provide growing income that can protect against inflation. A 3% initial yield that grows 5 to 7% annually can become much more attractive over time. Also, these companies typically have more stable business models and are less likely to cut dividends during economic downturns. Johnson & Johnson, for example, has increased its dividend for 59 consecutive years. Coca-Cola has raised its dividend for 60 straight years. These aren't just dividend payers, they're dividend growers. The tax treatment is also more favorable. Qualified dividends from these companies are taxed at capital gains rates, which are typically lower than ordinary income rates. You can invest in individual aristocrats or buy the NOBL ETF, which holds the entire portfolio of dividend aristocrats. The pros of this strategy include reliable and growing income, lower risk of dividend cuts, favorable tax treatment, and protection against inflation through dividend growth. The cons are obvious: lower current yields requiring much larger capital investments, and slower wealth building in the short term. For dividend aristocrats, you're looking at $1 million or more to generate meaningful income, but you get stability and growth. Here's where most successful dividend investors end up: a combination approach that balances current income with future growth. The barbell strategy combines high-yield investments for immediate income with dividend growth stocks for long-term wealth building. For example, you might put 60% of your portfolio in covered call ETFs and REITs for current income, and 40% in dividend aristocrats for growth and stability. With $500,000, you could allocate $300,000 to high-yield funds and realty income for about $2,000 monthly income, and $200,000 to dividend aristocrats for about $500 monthly income and future growth. This gives you $2,500 monthly starting income, with the potential for that income to grow over time as the aristocrats increase their dividends. If you want to accelerate your path to dividend freedom, here are the key tactics. First, maximize tax-advantaged accounts. Use your IRA and 401k to hold REITs and covered call ETFs, since these generate higher tax bills. Keep qualified dividend stocks in taxable accounts for better tax treatment. Second, focus on monthly payers. Companies like Realty Income and ETFs like the covered call funds pay monthly dividends, giving you more consistent cash flow that feels like a salary. Third, automate everything. Set up automatic investments and pay yourself first before spending on anything else. Fourth, reinvest dividends until you reach your target portfolio size. Use DRIP plans to automatically reinvest dividends and compound your wealth faster. Fifth, consider the 4% rule supplement. Even with dividend income, you might supplement with small portfolio withdrawals using the 4% rule for additional income. Before you get too excited, let's talk about the risks, because there are several important ones. Dividends are not guaranteed. Companies can and do cut dividends, especially during economic downturns. Just because a stock yields 8% today doesn't mean it will yield 8% next year. High yields can signal financial distress. Sometimes a stock has a high yield because the price has fallen due to business problems, not because it's a great investment. Inflation erodes purchasing power. If your dividends don't grow over time, your real income decreases as costs rise. Tax implications can reduce your net income significantly, especially with REITs and covered call ETFs that are taxed as ordinary income. Interest rate sensitivity affects many dividend investments. When rates rise, dividend stocks often fall in price, and REITs can be particularly sensitive. Let me give you 3 realistic scenarios based on different capital levels. Scenario 1. You have $300,000. Focus on covered call ETFs like the high-yield monthly paying funds. You can generate about $2,500 to $3,000 monthly, but accept limited growth and higher taxes. Scenario 2. You have $500,000. Use the barbell approach with $300,000 in high-yield investments and $200,000 in dividend aristocrats. Start with about $2,500 monthly income that grows over time. Scenario 3. You have $1 million. You can choose the aristocrat approach for $2,500 to $3,000 monthly with excellent growth prospects, or go heavy into REITs and covered call funds for $4,000 to $5,000 monthly income. Here's a practical framework for getting started. Start with your target monthly income. We use $2,900, but adjust for your needs. Determine your risk tolerance. Higher yields mean higher risk and usually less growth. Choose your core holdings. Pick 3 to 5 ETFs or individual stocks rather than trying to own everything. Automate your investing. Set up automatic contributions and dividend reinvestment. Monitor and adjust. Review quarterly, but don't make emotional decisions based on short-term volatility. This is crucial because taxes can destroy your dividend income if you're not careful. Hold REITs and covered call ETFs in tax-advantaged accounts when possible, since they're taxed as ordinary income. Keep qualified dividend stocks in taxable accounts to benefit from lower capital gains tax rates. Consider municipal bond funds for high-income earners, since the interest is often tax-free. Use tax loss harvesting to offset gains with losses in your taxable accounts. Living off dividends isn't just possible, it's achievable much faster than most people think if you use the right strategies. The covered call ETF approach can get you there with $300,000 to $400,000, but sacrifices growth. REITs need $350,000 to $700,000, depending on risk tolerance. Dividend aristocrats require $1 million plus, but offer the best long-term prospects. The hybrid barbell strategy probably makes the most sense for most people, combining current income with future growth. Remember, this isn't about getting rich quick. It's about building a systematic approach to generate passive income that can eventually replace your salary. The key is to start now, even if you can't invest large amounts initially. Every dividend payment reinvested compounds your future income. Whether you choose high-yield covered call ETFs, stable REITs, or growing dividend aristocrats, the important thing is to begin building your dividend machine today. Your future self will thank you when you're collecting thousands in passive income every month, while everyone else is still trading time for money. Thank you for watching my Money Mint.